Hello and welcome to our session on dividends. Now, in every organization, all things being equal, after making the right investment decision, financing it appropriately, working the capital to bring in profits, then comes the opportunity possibly to pay dividends to shareholders. Now, dividends constitute one of the ways in which shareholders or contributors of equity capital can recoup some of their gains from the investment aside from their capital gains. But whether or not to pay dividends, how stable they should be, how large they should be, are questions that confront businesses every day. So in this session, we're going to try and walk through the various positions on dividend payment and the relevant dynamics that are involved. Our objectives for this session will be to understand the dividend payment or the dividend retention versus distribution dilemma faced by firms, seek to understand and explain the Modigliani and Miller argument that dividends are irrelevant, explain the counter-arguments to the Modigliani and Miller proposition, which says therefore that dividends matter. So this is the counter-argument. Identify and discuss the factors that may affect a firm's dividend and retention policy, and also summarize the standard cash dividend payment procedures and relevant and critical dates. Our outline will be as follows: to look at the passive versus active dividend policies, factors influencing dividend policy, dividend stability, stock dividends and stock splits, stock repurchases, and administrative considerations. Now, as the finance manager, you've come across the underlining or the overarching concept of financial management, which is to maximize shareholder wealth. So in essence, every decision that is taken must always ask the question, will it maximize shareholder wealth? So the same in relation to dividend payments. The question to be asked, can the payment of cash dividend affect shareholder wealth? And if so, therefore, what dividend payout ratio will maximize the shareholder wealth? Now, all things being equal, the firm uses earnings plus the additional financing that it gets from increased equity values to support any positive NPV project. So as far as dividend as a residual is concerned, it's only unused earnings that are paid out in the form of dividends. So now that's for the passive dividend policy. So that dividends are more like an afterthought when all relevant positive NPV projects have been undertaken. Now, the question of whether or not to pay dividends and whether that has an implication on the value of the firm has Modigliani and Miller and the total value principle arguing that the sum of the market value plus any payments from dividends or not paying dividends at any point in time does not differentiate the value of the dividend paying firm from that of the non-dividend paying firm. Now, this MMM is working from the premise that in this kind of market, which is near perfect, investors can create their own dividends. So in essence, when the firm reinvests the extra surpluses in growing the business, the increased value from the equity shares, which provides a gain in the event of sale, can be accrued by the investor, in the sense that if the investor feels that they need cash, they can take one or two shares and sell them to create cash dividends, because whatever value it is they would have derived if they were to receive dividends with a term actual dividends is still inherent in the increased value of the share. So they're able to create their own dividends. The reverse as well, because the market is near perfect, if the firm should pay dividends and the market is not interested in the dividend, the investor can take that cash and go back and buy more shares. So in a sense, whether or not the firm pays dividend or rather reinvest to increase the share value of the firm, it does not, or provides shares in essence, does not necessarily change the value, because in essence, they are not really offering any unique service to the investor. So investors can create any dividend policy they desire by selling shares when the dividend payout is too low, or they buy shares when they believe that dividend payout is excessive. So by virtue of that, whether a firm pays dividend or does not pay dividend does not really engender any implication whatsoever for the value of the firm, which is normally inferred from the value of the shares. There's a counter argument, however, that says that dividends do matter. And the reason being that there is uncertainty surrounding the future profitability of firms, for which reason certain investors prefer certainty of dividends as opposed to any other. So that preference for dividend payments and relatively large dividend payments, because they are not sure how the future may turn out, means that firms that pay dividends are likely to perceive favorably and hence have an impact on the value. Now, when it comes to taxes as well, with capital gains, taxes are deferred until the actual sale of stock. So what it means is that for a timing option, so capital gains are therefore preferred to dividends because it defers, everything else equal. So high dividend yielding stocks should sell at a discount to generate higher before tax rates of return, and certain institutional investors pay no taxes. And so depending on the tax disposition of the investor, they either prefer to defer the capital, because they get to defer capital gains and pay much later. The impacts may be different depending on how it operates within the market in comparison to dividend payments. So the taxes that the investor is liable to pay on whether they receive dividends or they receive capital gains has a very significant influence on whether they have a preference for dividends now or capital gains later. So that really goes to prove also that the dividends do matter. So for some will prefer not now, others will prefer much later. So whether or not you pay dividends has implications for investors and therefore the firm value. Now, having moved beyond the point of proving that yes, there is relevance of dividend, because on another handle, there's also the implication for the clientele effect. There are some entities that prefer to have dividend payments, others prefer not to have dividend payments, so that the clientele effect also attracts the right, or should I say the relevant kind of investors to a particular firm. Now, dividends can also signal, so that when a firm is paying dividends, it's assumed that it has expectations that the future is also going to be profitable, for which reason it signals potential benefits. Also, that a firm pays large dividends could also signal good future prospects. So in the event that a firm should cut down on dividends for any reason, it sends a negative signal. So for that also means that whether or not a firm pays dividend, how much it pays, and in terms of how stable the dividends are, can have an influence on the value of the firm. Now, going forward, therefore, and having satisfied ourselves that dividends do matter, what are the factors that can influence dividend policy? Now, let's start with something in the area of legality. Now, many states or many entities or jurisdictions will prohibit the payment of dividends if the dividends impair capital. So either par value of common stock per additional. So anything that impairs, if dividend payment will impair capital, then there might be restrictions on the payment of dividends. There's also the insolvency rule. Certain jurisdiction prohibits the payment of cash dividend if the company is insolvent under either a fair market valuation or equitable sense. So once a firm appears insolvent, obviously it makes no sense to be paying dividends, because That literally means that funds meant for payment of other stakeholders may be used in paying dividends. Now, there's also the prohibition, the undue retention of earnings in excess of the present and future investment needs of the firm. So there are jurisdictions that do not encourage undue retention of earnings. So we have the undue retention of earnings rule. Other issues that may crop up in influencing dividend policy constitute the funding needs of the firm. So if a firm has funding needs, and since retained earnings constitute one of the cheapest forms of funding or financing, looking at the pecking order theory, then the firm is likely to use the funds to finance its projects as opposed to paying dividends. Also, whether the firm is liquid is also a factor that will influence its dividend policy. Whether it has the ability to borrow would also determine whether or not it will pay dividends. And whether there are restrictions in its debt contracts, like protective covenants, in the sense that when certain firms borrow, or when firms borrow, certain covenants may be put in the debt contract that prohibits the payment of dividend until the debt is resettled, and then other issues like control implications. Now, there are types of dividends. We could have a regular dividend, which is the normal that is expected to be paid by the firm, and then there's the extra dividend. Now, this one is non-recurring and only happens usually under certain or special circumstances. Now, when it comes to dividends, what do we really have? We can actually have stock dividends. When we say stock dividends, instead of receiving cash, you receive stocks in commensurate value to the cash dividends that you were to receive. So we also have a stock split, which is related. What it just means is that you take the stocks and you split them by a certain factor. So let's take a case where sometimes you have a stock that is trading in a very high price bracket, but within the market space in which it trades, not many people. So let's say in Ghana, at a point, Standard Chartered was trading in the region of about those times 80 cedis for one and all that. And so the average person looking to buy maybe 100 shares would need about 8,000 Ghana cedis. And for them, 100 shares, 8,000 seems to have other different interpretations. But by splitting the stock, maybe a 2-for-1, for example, now it means that for every original share of one that was priced at 80, we now have 2 shares in its place. Now what that really does is to double the number of shares, but half the price per share. So in terms of intrinsic value, the value of the firm hasn't really changed in terms of the capitalization. But now by reducing the price, it becomes accessible to the average person to be able to also participate in the trading of the firm. And of course, by making that, it also, in a sense, underscores it potential to increase the trading with respect to that particular stock, adding a sense of liquidity, which is very important for the stock market. Now, whenever there's stock dividends or stock splits, it can have implications on investor total wealth. It could also have effects on the investor's psyche. It could have effects on cash dividends, and then also effects by like moving the firm into a more popular trading range, and then informational content. Now, a reverse stock split is just, like I say, is the reverse of what is a normal stock split. So with a stock split, you take one stock and you split it into a number of units. With a reverse, it means that you're taking a number of stocks and boxing them into one. Now, what it does is to reduce the number of shares outstanding. It doesn't really change the proportionate holding of investors, but then it reduces the number of shares outstanding. Now, normally what we do is to use this to also move a stock into a popular trading range and increase demand depending on what is on the ground. But it may actually signal negative information to the stock market, so that we can also look at an example where we have 400,000 shares at 5 par value. And if it's placed 1 for 4, how does that impact? So in this case, you get 1 for every 4, so it becomes a reverse. In which case, the final value 1 for 4 means that every 4 now equates to 1. And then to the question to ask, how does that impact the shareholders' equity accounts? Usually it means that it's going to shrink that. And then we also have the case of stock repurchases. Now this is usually a buyback of shares by the issuing firm, either in the open or secondary market, or by what we call a self-tender offer. Now the reasons a firm may want to undertake a stock repurchase is because it may be available for management stock option plans. There's also available for the acquisition of other companies. And then going private, sometimes by repurchasing all stocks on the firm, then they can go private and move outside, in terms of sometimes for some even delisting, and then sometimes to permanently retire those shares. Remember, shares are usually issued by firms in search for capital or funding to grow. So maybe if they have grown to the point where they believe they have some extra financing, they may decide to buy back these shares and literally take these shares off the market. Now, how do they go about the repurchase if they decide to do so? Is the fixed price self-tender offer, which is normally an offer by a firm to repurchase some of its own shares, typically at a set price. Then there's also the Dutch auction self-tender, where a buyer bids and then for a large stock of shares typically, and then after evaluating decides to pick or buy or sell off, it depends on the buy and the sell or the sale, which of the packages or consignments provides the most affordable. Then there's the open market purchase, where a company just repurchases its stock through a brokerage house on the secondary market. Now, repurchasing as a part of dividend policy, they're usually most relevant for firms with large amounts of excess cash that might otherwise generate a significant taxable transaction to investors, so that they buy back shares and literally transfer cash to the investors through a share repurchase. But then firms must know that it should not make that a recurrent activity, as it may bring about the revenue services. Now, whether or not to consider repurchase and stock repurchase as investment or financing decisions, typically they are not really investment decisions or investing decisions, as the stocks that are repurchased are held as treasury stocks and do not necessarily provide an expected return like other investments. In terms of the financing decision, it possesses capital structure or dividend policy motivations. For example, a repurchase immediately changes the debt to equity ratio, because by repurchasing stock, it reduces the quantum of shares on the market. It can actually trigger an instant higher financial leverage position. Now, having made the decision of whether or not to pay dividends and the mode of payments, now there are a number of administrative considerations that need to be looked at, and that has really to do with the procedural aspects. One of the first things to keep in mind is what we refer to as the record date. Now, this is typically the date that is set by the board of directors, and that's when the dividend is declared. When the dividend is declared, the board of directors set a date on which an investor must be a shareholder of record to be entitled to the upcoming dividend. So that's the date of recording. So on that day, if you're not a shareholder by that date, typically it means that you do not qualify to receive the dividends when they are declared. Now, so the board of directors, for example, met on, let's say, 8th May to declare a dividend payable to shareholders on June 15th, to the shareholders of record on May 31st, meaning that by May 31st, only those who are recorded as being shareholders are those who will receive the dividend to be paid. Now we have the ex-dividend date. Now that's the first date on which a stock purchaser is no longer entitled to the recently declared dividend. So the buyer and sellers usually have several days to settle for after a transaction. So the brokerage industry has a rule that new shareholders are entitled to dividends only if they purchase the stock at least 2 business days prior to the record date, because that's the time it will take to process and make you an official shareholder. So that becomes the ex-dividend date, meaning that after that, you're no longer qualified to receive the dividends. And then the declaration date is the date that the board of directors announce the amount and date of the next dividend. And the payment date is the date when the corporation actually pays the dividend. So now that brings us to the end of our lesson on dividends. See you in our next lesson. Bye.